In this video, we're breaking down 3 oversold stocks that Wall Street is quietly accumulating while most investors are still distracted by short-term noise. These are businesses sitting at the center of massive long-term trends, trading far below their highs, and positioned to compound for years if they execute. You're about to see how automation, global money movement, and digital advertising ecosystems are evolving, and why these companies are not just surviving this market, they're setting up for the next leg higher. There's a company in this list that is quietly becoming the backbone of how businesses automate repetitive work across industries, not in theory, in real workflows, in real enterprises. And yet, its stock has been cut nearly in half from its highs. That's where we start. Let's talk about UiPath, ticker PATH. Most investors still misunderstand what UiPath actually does. They hear automation and think it's just another software tool. But what UiPath is building is far more powerful than that. It is essentially the operating layer for digital labor. Think about the number of repetitive tasks inside any large organization: data entry, invoice processing, customer onboarding, compliance checks. These are not small problems. These are billions of hours of human work every single year, and most of it does not require creativity, it just requires execution. UiPath replaces that with software robots, not in some futuristic way, in a very practical, enterprise-ready way that companies are already deploying today. And here's the key insight most people miss. This is not just about cost savings, it is about scalability. When a company automates workflows using UiPath, it is no longer constrained by human bandwidth. It can scale operations faster, reduce errors, and improve margins at the same time. That is a powerful value proposition. This is why UiPath has been able to build relationships with thousands of enterprise customers across industries like finance, healthcare, and manufacturing. These are not small clients testing things out. These are mission-critical deployments. Now here is where things get interesting from an investment perspective. The stock is down roughly 43% from its highs. That kind of drawdown usually signals one of two things. Either the business is broken or the expectations got too far ahead of reality. In UiPath's case, it looks much more like the second. Growth has slowed compared to the hyper-growth phase that investors got used to. But the business is still expanding, still adding customers, and still generating strong recurring revenue through its subscription model. Annualized recurring revenue has continued to grow, and the company has been steadily improving its profitability profile. Operating losses are narrowing, and management has been focused on driving efficiency rather than chasing growth at any cost. That shift matters, because in today's market environment, investors are no longer rewarding companies just for growing fast. They want sustainable growth, they want operating leverage, they want a clear path to profitability. UiPath is moving in that direction. Another key piece of the story is artificial intelligence. Automation on its own is powerful, but when you combine automation with AI, you unlock something much bigger. Now you are not just automating simple rule-based tasks. You are enabling systems to make decisions, interpret data, and handle more complex workflows. UiPath has been integrating AI capabilities into its platform, allowing its software robots to become more intelligent over time. This expands the total addressable market significantly. It also strengthens the company's moat, because once a business builds its workflows around UiPath's platform, switching becomes extremely difficult. These automations are deeply embedded into operations. Replacing them would require time, money, and risk. That creates stickiness, and in software, stickiness is everything. Now let's talk about why Wall Street might be quietly accumulating this stock. When a high-quality software company sells off this much, institutional investors start paying attention. They are not looking at the last quarter. They are looking at where the business could be in 5 to 10 years. And the long-term thesis here is simple. The world is moving toward automation, not slowly, rapidly. Companies are under constant pressure to reduce costs, improve efficiency, and do more with less. Automation is not optional anymore. It is becoming a necessity. UiPath is one of the leaders in that space. And at a time when many investors are focused on short-term growth rates, the market may be underestimating how large this opportunity actually is. If UiPath continues to execute, continues to expand its platform, and continues to improve margins, the current valuation could look very attractive in hindsight. But this is not a risk-free investment. Competition is increasing. Large tech companies are also investing heavily in automation and AI. Execution will matter. Customer retention will matter. Product innovation will matter. This is not a set-it-and-forget-it stock, but that is exactly why opportunities like this exist, because when uncertainty is high, prices disconnect from long-term potential. And that is where disciplined investors step in. UiPath is not perfect, but it is building something that sits at the center of a major structural shift in how businesses operate. And that is the kind of story you want to pay attention to when the stock is down over 40%. If this resonates with you, you're exactly who this channel is for. People who are ready to stop losing money in the market and take their investment portfolio to the next level. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to a company that most investors are still underestimating, even though it sits at the center of a massive and growing global market. We're talking about Remitly Global, ticker RELY. At its core, Remitly is transforming how money moves across borders. That might sound simple. It is not. Global remittances represent hundreds of billions of dollars flowing every year. This is money sent by immigrants and workers abroad back to their families in home countries. It is one of the most consistent and resilient financial flows in the world, and historically, this space has been dominated by outdated systems, high fees, slow transfers, poor transparency. Remitly is changing that. The company has built a digital-first platform that allows users to send money internationally faster, cheaper, and with a much better experience than traditional providers. And that difference is not marginal, it is meaningful. Lower costs matter when you are sending money to support your family. Speed matters when that money is needed urgently. Trust matters when every dollar counts. Remitly understands this deeply, and that is reflected in how it has designed its product and built its brand. Now here is where the investment opportunity starts to become clear. The stock is down about 28% from its highs, but the business itself has continued to grow at a very strong pace. Customer adoption has been increasing, active users are rising, and the total send volume on the platform continues to expand. More importantly, Remitly is not just acquiring users, it is retaining them. And in a business like this, retention is everything, because once someone trusts a platform with their money, they tend to stick with it. That creates a powerful network effect over time. As more users join, more transactions flow through the platform. As more transactions flow through the platform, the company can optimize pricing, improve margins, and reinvest into better services. This flywheel is already in motion. Revenue has been growing rapidly and the company has been making steady progress toward profitability. Losses are narrowing as scale improves and operating efficiency is becoming more visible. That is exactly what you want to see in a high-growth fintech company at this stage. Now let's zoom out for a second. The global remittance market is not going away. In fact, it is expanding. As migration increases and global labor mobility continues, the need for cross-border money movement becomes even more important. And traditional players are not built to adapt quickly. They are burdened by legacy systems, physical locations, and higher cost structures. Remitly does not have that problem. It is built for the digital era. That gives it a structural advantage, and here is where Wall Street's quiet accumulation starts to make sense. When you have a company operating in a massive market, gaining share, improving margins, and trading below its previous highs, it becomes very attractive for long-term investors, especially when the story is still early. Because Remitly is not yet a fully mature business, it is still expanding into new corridors, adding new services, and deepening its relationship with customers. This is not just about sending money anymore. Over time, Remitly has the potential to become a broader financial platform for underserved and globally mobile populations. Think about what that means: savings products, credit offerings, financial tools tailored for cross-border users. If the company executes on that vision, the opportunity becomes much larger than what the market is currently pricing in. But again, there are risks. Competition in fintech is intense. Pricing pressure can impact margins, regulatory environments can shift depending on regions. Execution is critical. However, the combination of strong user growth, improving financials, and a massive addressable market creates a compelling setup. This is the kind of company that does not need perfect conditions to succeed. It just needs to keep executing. And so far, it is doing exactly that. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's talk about a company that almost everyone thinks they understand, but very few investors are actually valuing correctly right now. We're talking about Meta Platforms, ticker META. This is one of the most dominant digital ecosystems ever built. Billions of people use its platforms every single day, not occasionally, daily. That level of engagement is incredibly rare, and it creates something that is extremely difficult to replicate: attention. Meta owns attention at scale, and wherever attention goes, advertising dollars follow. That is the foundation of this business. Now here is what makes this opportunity interesting right now. The stock is down roughly 41% from its highs, but the business itself has not deteriorated in the way that price action might suggest. In fact, in many ways, it has become stronger. Let's break that down. Meta generates the majority of its revenue through digital advertising across platforms like Facebook and Instagram. These platforms are not just social networks anymore. They are full-scale advertising engines powered by massive amounts of user data. That data allows advertisers to target audiences with incredible precision, and that is what makes Meta so valuable. Because in advertising, efficiency matters. Companies do not just want to spend money, they want to see results. Meta delivers that. Even in a challenging macro environment where many companies are pulling back on ad spending, Meta has continued to show resilience. Engagement remains high. Advertisers continue to rely on its platforms to reach customers. And here is where the long-term story becomes even more compelling. Artificial intelligence. Meta has been aggressively investing in AI to improve its ad targeting, content recommendations, and overall platform performance. This is not just a side project, it is becoming a core driver of growth. Better AI leads to better recommendations. Better recommendations lead to more engagement. More engagement leads to more ad impressions. And more ad impressions lead to more revenue. It is a powerful feedback loop. And it is already showing results. The company has been improving its efficiency, reducing costs, and focusing on profitability after a period of heavy investment. Operating margins have been recovering, and management has made it clear that discipline is now a priority. That shift has not gone unnoticed by institutional investors. Because when you combine a dominant platform, improving margins, and long-term AI tailwinds, you get a very compelling setup. Now let's talk about something that has weighed on the stock, the metaverse. For a while, this became the central narrative around Meta. Massive investments, uncertain returns, long timelines, and that created skepticism. Investors questioned whether the company was allocating capital effectively, but here is the thing, the core business never stopped working. While the headlines were focused on the metaverse, Meta continued to generate billions in cash flow from its advertising engine. It continued to invest in AI, it continued to refine its platforms, and now, as cost discipline improves and AI starts to drive measurable results, the narrative is shifting. Quietly. This is exactly the kind of situation where Wall Street begins to accumulate shares. Not when everything looks perfect, but when the business is strong, the narrative is improving, and the stock is still reflecting old concerns. That is where the disconnect happens, and that is where opportunity exists. Meta also has another advantage that is often overlooked. Scale. At its size, even small improvements in efficiency or engagement can translate into massive increases in revenue and profit. Few companies in the world have that kind of leverage. And when you combine that with ongoing innovation in AI and advertising technology, the long-term potential becomes very difficult to ignore. Of course, there are risks. Regulatory pressure is always a factor. Competition for user attention is increasing. Platform dynamics can shift over time. But Meta has proven its ability to adapt. It has navigated multiple platform transitions, from desktop to mobile, from feed to video, and now toward AI-driven content discovery. That track record matters, because in technology, the ability to evolve is often more important than the current product. And Meta has shown that it can evolve. So when you step back and look at the full picture, you have a company with massive global reach, strong cash flow generation, improving operational efficiency, and powerful long-term growth drivers through AI, all trading significantly below its previous highs. That is not something long-term investors ignore. That is something they study closely, and in many cases, quietly accumulate. Now when you compare all three of these businesses, something interesting starts to emerge. You have UiPath, which is building the infrastructure for automation across enterprises. You have Remitly, which is modernizing global money movement in a massive and growing market. And you have Meta, which continues to dominate digital attention and monetize it at scale while integrating AI across its ecosystem. Each of these companies operates in a completely different space, but they share one important characteristic. They are all positioned at the center of long-term trends that are not going away. Automation, global financial connectivity, digital advertising powered by AI. These are not short-term themes. These are structural shifts. And when high-quality companies tied to these shifts pull back significantly, it creates opportunities for investors who are willing to look beyond short-term noise. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now here is a question for you. Which of these businesses do you believe has the strongest long-term competitive advantage? Is it UiPath with its deep integration into enterprise workflows, Remitly with its growing network and global remittances, or Meta with its unmatched scale and data-driven advertising engine? Let me know your thoughts in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.